Hello and welcome to Fintech Insider Insights. I'm David Brear, Group CEO here at 11FS. In today's episode, we're going to be asking, can the UK avoid a mortgage market meltdown? Sadly, the news for the UK mortgage market is currently a little bit more brutal than a Tarantino film, isn't it? July saw the 2-year fixed rate mortgage hit its highest rates in 15 years at an ominous 6.66%. It feels like we probably need a priest and some holy water at this stage potentially, but it is definitely fair to say, though, that things are looking extremely difficult right now for many homeowners looking to renew their deals in the coming months and facing extremely elevated lending costs, while at the same time highly increased cost of living and a real general squeeze on affordability. While only 37% of people in the UK have a mortgage, this squeeze really hurts everybody down the line, whether it's those renting or even those looking to get onto the ladder as well. And with rent going up dramatically and inevitably house prices being depressed with this also, then everybody is really feeling that squeeze. This is all leading to an oddly spread out financial crisis, with one domino having a real impact on the next and causing issues further down the line for everybody. Sadly, we've also seen this movie before, particularly the American version in 2008. And we all know how that ends, and we all know it doesn't particularly work out well for the wider economy. But man, that is the most depressing intro I think I've ever got through. But what can actually be done by this? Can we avoid this potential fate? And all of this is what we're going to be exploring with a panel of really amazing guests. We're going to be looking at how do we get to this point? What can we do actually about it? And really, what does the next 6 months to a year hold for us all here in the UK market? We'll discuss all of this and much, much more on today's show. But first, a few brief messages. Don't go anywhere. Fintech Insider community, we need your help. The 11FS Awards returns on Wednesday, 15th of November, and we will be celebrating the people and businesses from across the globe who are helping to move the industry forward. This is where you come in. Do not miss your chance to influence who takes home an 11FS Awards trophy, whether they're trying to make the world a better place for their customers, changing the game for businesses, or utilizing AI to improve their customer experience. We want you to tell us who is building the best stuff. Submit your nominations right now at 11fsawards.com. That's 11fsawards.com. All right, let's get started. As always, I am joined by a panel of outstanding guests who can shed some light onto the question. First, it is great to be joined by Ben Thompson, who is the Deputy CEO at the Mortgage Advice Bureau. Thanks for being here, Ben. How are you doing?
Yeah, very good. Thank you very much indeed. And thanks for having me here.
No problem at all. For any listener who doesn't know, give a bit of an overview of you, your role, and what the Mortgage Advice Bureau does.
Yeah, basically, well, my title is Deputy Chief Executive. I run Mortgage Advice Bureau. We're a national network stroke mortgage broker with about 2,200 advisors, roughly. And we advise on, obviously, mortgages and protecting those that move home or refinance. That's me.
Very cool. Very, very topical. I'm sure you guys are super busy in this period as well.
Yes, very.
We have a Fintech Insider debut also for Dinesh Vora, who is the CEO over at Sprive. Welcome to the show, Jinesh. How are you doing?
I'm doing well, David. Thanks for having me.
Yeah, no problem at all. Long time. For anybody who doesn't know, what do you guys do over at Sprive?
Yeah, sure. So we're a fintech app that helps homeowners pay off their mortgage faster. So some of your listeners might be familiar with apps like Moneybox, Plum, Chip, help you squirrel away cash for the purposes of saving to invest. We're helping people pay down their mortgage debt. We launched about 18 months ago. We now have about 23,000 customers chipping away at their mortgage. The average customer at Sprive is on track to save about £8,000 in interest and pay off their mortgage 3 years earlier.
Very cool, very cool. Very topical as well. So we'll definitely be talking about that a little bit more. And finally, it is a welcome return to Fintech Insider for Maria Harris, Director of Digital Cat Consultancy. Welcome back to the show, Maria. How are you doing?
Thanks, David. Lovely to be back. Thank you.
It sounds like you're in a better place than all of us. You're over in Spain, is that right?
Yes, I am. So I moved here in September and thankfully get to work from home most of the time, which is nice.
Very good. Rising mortgage rates and rising temperatures over in Spain, I understand as well. So it's Great. For anybody who doesn't know, tell us a little bit more about the work that you guys do at Digital Cat Consultancy.
Yep, so most people know me from the mortgage industry, where I joined in 2006, right before that Hollywood blockbuster that you mentioned. So Digital Cat works with mortgage lenders and mortgage technology firms. We help them to digitise what they do. I also chair the Open Property Data Association, who are writing the data and technology standards to try and digitise the home buying process. And I am a non-exec director with United Trust Bank, who are a specialist bank based in London.
Very cool, and very busy, I imagine, with all of that as well. But well, thank you very much for joining us, everybody. Let's dive in. Maybe if we start the conversation by looking at really how we got to this point. Maria, the floor is yours. I mean, we've gone from incredibly low rates. I mean, there's a whole generation of people that forgot interest rates were a thing, wasn't there? And for the last 15 years, that's been how it's been so. But how has this happened? You know, we for anybody looking at the Bank of England graph, they would think something is very, very wrong.
Absolutely. And we have got very conditioned over that 15-year period to what was an artificially low interest rate. And that was driven by so many things that are kind of, outside what most people need to know about how money works, around monetary policy, the kind of recovery after the global financial crisis, the global interest rate environment's been really low, which means all countries kind of follow the same pattern. And we've had a lot of financial support that's come from central banks. So things like quantitative easing, government schemes, lots of housing stimulus, help to buy, all of those kind of things. And we've kind of forgotten that that's not normal, that actually having interest rates between 5 and 6% were the long-term average. And that's kind of the basis that we worked on. And I think there was always a plan that we would kind of slowly have that route back to normal. And, that's been accelerated in a way that I don't think any of us predicted. We talk about this kind of trilogy of black swan events that we've had with COVID and then the war in Ukraine and now a cost of living crisis. And those kind of things are things that you plan for once in 100 years. And we've had 3 of them in the last 3 years. So, yes, I think the acceleration's been a lot steeper than any of us were expecting it to be.
Yeah, and Andrew Bailey's obviously sort of come out from the Bank of England and sort of said that this is sort of why we're doing it. And there's a little bit of ambiguity around the edges there of really what they're trying to do. But, after 18 months of 12 consecutive base rate rises, I mean, is this necessary, as you say, to get us back to where we should be? Because there's a lot of people probably holding their breath, hoping it goes back to where it was, 2 years ago rather than where it was 10 years ago. But is this necessary, do you think, in terms of the sort of steadying the ship from a UK economy perspective?
So I think the preference would have been to have a kind of a slower and a more controlled change path to get where we are. And I think the intention was always to get back to somewhere closer to 5, because like I say, that is kind of the market norm. But the markets are very much based on, confidence and stability and being able to predict what's going to happen. And that's probably the biggest thing that impacts the cost of mortgages rather than base rate. But that confidence is absolutely driven from base rate. So I think, the market's used to pricing in expectations, and that speed of changes is just way faster than it should have been. So I think we could do with a little bit of a period of calm and not having any changes. So, the US inflation fell this week, which is hugely helpful. That's a 2-year low. The news that came out today about UK inflation dropping, and more importantly, the underlying inflation dropping, because that's the thing that Bank of England take their kind of stimulus from. So I'm hoping that just means that we can have a little bit of a period of calm, the kind of markets can just have a bit of stability, and then we actually have a plan on how we get back to whatever we're planning for longer term with a level of confidence and a level of predictability, which is what markets like.
The only thing I'd quickly add to that is just the fact that the markets are already pricing in off the back of that good news this morning, or less bad news, if you like, less of a rise in interest rates as we look forward. That's softened already this morning and will probably soften further. And I think that's good news for everybody. Long way to go, though. And
it's worth maybe sort of touching on that, Ben. I mean, how are advisors and how are mortgage firms more broadly sort of reacting to in this period? Because, I mean, obviously there's lots of sort of conversations around how quickly rates get passed through when it comes to savings, but obviously the mortgage rates change dramatically overnight, and that has a really significant effect on people's day-to-day expenditure, doesn't it?
It really does. And I think what's so unfair, if you like, around monetary policy, in particular base rate increases and sort of the cycle of people being on typically 2 and 5 year fixed rates, is there's a bunch of people taking serious pain now because they've had to refinance into higher rates. And there's a whole load of people that might still have 2 or 3 years left on a fixed rate at a really low rate. So it's quite unfair, if you like, that sort of relatively blunt instrument these days in terms of base rate used to sort of, curb inflation, if that makes sense. But at consumer level, I think customers and advisors have been fantastic through the last 10 months. They really have. One of the good things around mortgage customers at the moment is they've been underwritten quite strictly over the course of trying to work the maths out, probably the last 9 years. Where there's sort of been a bit of a buffer applied to underwriting. So although people can afford a certain level of mortgage, can they afford it if rates go up much further? So the underwriting's been great. That's created conditions where people have been able to get through, in particular the last 10 months. But of course, it's only affected a number of borrowers, and there's many, many more who it will affect in the sort of the coming months and sort of couple of years. And that's been difficult. But on the whole, we've not seen any what I call real negative fallout from it. Yes, it's painful. The customers are paying their mortgages, and they're very, very largely paying their mortgages, and that's all okay. And we're getting through it because of that tough underwriting that's gone down in sort of the previous decade.
And just to, I guess, just to sort of double click on that to a certain degree, because, as you say, this isn't just a base rate change in mortgage rates that's affecting things in that world, is it? We've seen, cost of living crisis is a compounding factor to this in terms of real affordability in that sense as well. So, there's lots sort of written about the potential really that there's a good slug of the UK market who are kind of stuck between a rock and a hard place. If they come off a fixed rate mortgage and the cost of living crisis has essentially affected their real truest sense of affordability, they're probably unlikely to be able to continue paying the existing mortgage, let alone a significant increase. So do you think that's something, is there this sort of ticking time bomb, do you think, in the market for a good proportion of the market? Or to your point just now, do you think that the market is ready to absorb those additional costs?
I think it's more the latter. So ticking time bomb, I'd say definitely no, as best we can say at the moment. We've got a pinch point here at the moment, and it's particularly unpleasant for those who are refinancing from low rate to high rate now, and have also still got the legacy high costs of fuel and other expenditures such as food and things. But what you tend to see, and the pace of this change is different these days versus a couple of decades ago, is markets sort themselves out. So when you've sort of got a pinch on affordability from energy, from food, from many other, even furniture and other things in the last sort of 18 months or so, then you've got the rise in interest rates, which drives up mortgage payments. Suddenly people have less disposable income. Inflation peaks and comes down, and gradually everything falls back and eases back. Look at petrol now. I think it's 25% cheaper than it was not that long ago. That's already coming back. That's going to affect forward-looking fuel prices and stuff like that. We know factory pricing of sort of food and stuff is coming down. That means in sort of 6 to 9 months, we know that price of food will come down. And obviously inflation is on a path downwards, in particular following the good news this morning. And that's the market sorting itself out. So the worst time is this pinch point now. I feel desperately for people who are going through refinancing in particular this year. But as we look into next year, we'll probably know where inflation has peaked. We'll know where interest rates have peaked. And maybe even possibly they're coming off or down from where they currently are. It's towards the back end of this year, for example, and then the position gets slightly easier for everybody. So it's a particular pinch point at the moment, but no, it's not an Armageddon thing.
I love your optimism. I'm
always the optimist.
I'm definitely grateful I'm not remortgaging in the next 6 months, as you say, but it's I can definitely sort of see the pain that those people could kind of go through. Jinesh, it's an interesting time, and in any sort of crisis of any type, there's always opportunities. And I guess with you guys being mortgage related platform in that sense, then this is an opportunity to help people, right?
Yeah, I think you're completely right. I think obviously it is a tough time for many homeowners. We talked about cost of living and rates rising, but there are solutions out there like Sprive that can kind of help people. If we look at our audience base, you've got people who are still on those low rates and they're desperately now trying to overpay their mortgage, trying to chip away, to try to bring that balance down, so that they ultimately pay less interest, maybe improve their loan to value. So when they do come to like refinancing, they can kind of secure some cheaper deals. And the beauty of the app with Sprive is that it adjusts based on your spending, because you link your bank account by open banking. We have a very good idea of how much people can afford, and they can kind of set aside. And if you spend lots of money compared to the norm, then we set aside less money compared to weeks and months where you're spending lots of money and you've got a lot less money kind of to put towards your mortgage. And then we've come up with like innovative solutions. So when we were talking to our customers, we kind of saw this coming very quickly. Rates rose, but one of the things we do is just constantly talk to homeowners around what their kind of challenges are. And one of the things that became very apparent about a year ago is that people saying that, with the cost of living, that's going to be very difficult to start even putting extra money towards the mortgage, even if you're talking about a few pounds equivalent a day. And so we started building what we call Shop with Sprive, which is basically everyone's got to eat, everyone's got to do their weekly shop. And so we started partnering with lots of like main top tier brands. So now we've got Asda, Sainsbury's, Morrison's, M&S, Iceland, Waitrose, and a whole plethora of top tier brands where every time our customers do their shopping, they can essentially pay off their mortgage faster and again, get the benefits of saving money. So it definitely is a tough time, but we're trying to come up with innovative solutions to just help people kind of move that needle.
Yeah, I mean it's a fascinating one, isn't it? As much as you say and Ben, as you say the market, there is sort of slices of the market that are more greatly affected by it. When anybody starts to see anybody struggle or anybody panic, I mean the last crisis really was based on confidence, wasn't it? Confidence in the financial system, confidence in anything. People's confidence in those organizations that are there to kind of support them. There's some statistics that the producers have sort of put in of how concerned homeowners should be about this. And we saw 56% of people were very or somewhat concerned by the potential future increase in cost of mortgages. I mean, when more than half of the country is very or somewhat concerned by that. I mean, that's a big movement, isn't it? On top of everything else as well, that we're sort of seeing in the market, I guess, because it's worth sort of saying, and we've sort of touched on this in various different angles. This is not one slice in its own right, but very much with political unrest and recession more broadly, all of the different changes that we've sort of seen. This really is the culmination of different changes in the market, isn't it? Rather than just one of those triggers. So it's a weird one, isn't it? I guess, Ben, maybe just to touch on your point you made earlier on around the, before we sort of move on a little bit, but to touch on your point around the base rate being a little bit of a bit of an archaic way of steering the ship when it comes to the UK economy. Talking a little bit more about that, because I mean, I think while obviously I sort of touched on this in the intro about a third of the UK has a mortgage, making these changes in the way that the Bank of England is doing, they attempt to change the entirety of the economy in its right, doesn't it? But the squeeze on that third is over dramatic, maybe I'd say.
Yeah, and it's not just a squeeze on the third, it's a squeeze on a percentage of that third as well. And that's why I think it's a blunt tool, because you've got a bunch of people on fixed rates who won't come off. It staggers up over the course of the next 3 or 4 years, if that makes sense. And I think the peak of the pain point is in Q1 2025. But I think what the bank's doing, I don't think it has many alternatives. If you raise, for example, income tax or VAT across the board, it's deeply unfair, and a 2/3 are not mortgaged, and I could go on about that forever. Of course, it'd have an immediate impact, but the fallout is significantly worse, and politically as well. So I don't believe the bank has a choice. But I think one of the positives from the negatives, if I can describe it this way, is the mood all this creates on the high street in households. It's sufficiently dark enough to curb spending, and eventually the mood will catch up such that pay rises are lower. We're already seeing employment vacancies, for example, are markedly lower than they were. And gradually it becomes apparent that we can't spend perhaps as we have been, even though that's definitely not the primary cause, to be clear. And we will get through, and inflation will come back, and it will fall quite quickly when it falls. So we do get to where we need to get to. In the same way as back in September 23rd, I think it was last year, instantly, within 24, 48 hours of that mini budget, we knew what was going to happen. So we could foresee where we're going to be in sort of Q1, Q2. You could see immediately this is going to be painful, and this is how it's going to play out. In the same way, I'd say now you can sort of look forward and think, well, off the back of the good news that Maria mentioned earlier this morning in terms of the inflation figures being sub 8%, you can now look forward with a degree of confidence that we're not that far from the peak. And if we're not that far from the peak, that's potentially good news for borrowers in the medium to longer term. So I don't think they've got much of a choice other than what they're doing. And the mood that's been created from the bank and into the press in particular is we need to take some pain, which I think is unfair. What I would personally like to see is a period of flat for some time. I don't want to see a recession for obvious reasons. Don't want to see households hurt, but we do need to go through a period of flat. And that will sort this out.
Yeah, do you know, Ben, I think you're absolutely right about that mentality of people catching up, though, because I think the ONS stats for last week were that the last week in June, first 2 weeks in July are the first time that we've actually seen a drop in discretionary spend across the board. I think it was something like 63% of people had reduced their spending. And that's the first time that that's happened, because in April and May, those numbers were still going up, and we had bank holidays and amazing weather and lots of really good reasons to go out and buy food and drink and outdoor clothing and things to do outdoors, and the weather was fab, and all of those things increased spending, which actually really didn't help with inflation. So it's almost like that spending change, or that spending expectation of discretionary spend is starting to come in now, and we do need that. We just need people just to take that pressure off so that everybody else can catch their breath.
It's going to be interesting to see, isn't it, going into the holiday period? Do people sort of reduce that down, and are we going to see a little less people jetting off to sunnier climates to save a bit of money? But maybe I guess having looked at how we got ourselves into this situation, then what do we do? What do we advise people to do? Because there's going to be people listening to this show who not only are kind of fintech nerds, banking nerds like us, but actually people who are in this situation of a fixed mortgage coming to an end. Ben, maybe starting with you. What are advisors advising people to do in this period of time?
Well, again, you've got difficult baskets of people, if that makes sense. You've got people who are perhaps not particularly highly geared. They haven't borrowed that much. Maybe prepared to take a bit more of a gamble and say, fix for 2 years, wait for rates to be lower at the end of the 2-year period. And then obviously you're selecting a lower rate at the end. That's quite a brave thing to do. But if you're not highly geared, it's an option. In the same way, you could take what's called a tracker mortgage, which tracks the Bank of England rate. Obviously, those rates are relatively low compared to some of the other fixed rate products available. Same point, if you think rates are near the peak of the cycle, they'll go up a bit maybe, but then they'll come down maybe again on the other side. That's a gamble that someone who's not borrowed that much might be prepared to take. But in the main, nearly all the sort of the advice we're giving and the conversations we're having with customers are around, just lock in at your best rate you can get. So we're seeing still 5-year rates at relatively competitive numbers. Yes, they're way higher than they were 18 months ago. And if that enables you to budget over this next 5-year period, you're not taking a risk with your family expenditure and sort of income and outgoings and everything, still fixing at that level by historical standards is actually very low. So why wouldn't you take a 5-year fix? So if there's any risk, we're advising people to take the lowest fix, which is typically a 5-year at the moment. And it's only really those that are prepared to take a really thinking view in terms of inflation peaking in the near term who are prepared to go for sort of a 2-year fix or a tracker. If in doubt, fix. You can't typically go wrong. Then the natural question we get to finalise the point on the other side is, if in 18 months' time interest rates have come down 2%, 2.5% to give an extreme version of where it could go, what happens if I'm overpaying? Well, I'd always say to someone, well, firstly, you knew what you're paying in that period of volatility anyway. So it's kind of like an insurance product. And secondly, there comes a point in the cycle where rates have gone so low, you can come out and pay a penalty anyway. And you need to get advice around that. But of course, I would say just if in doubt, fix.
Very good. Maria, maybe coming to you on that one. I mean, I've heard, when your friends give you completely unsolicited advice, or taxi drivers in and around London as well. I'm sure it's everywhere in the world that does this. But there is two sort of schools of thought there, isn't there? There's the, ride the variable rate until some sort of normality comes. Although to your point, Maria, actually the rate numbers that we're at is more like normality if you zoom out far enough, isn't it? But equally, actually, could it get a lot worse, and therefore is a fixed rate opportunity the best way? What do you think right now? No, I should have added at the beginning of this, none of this is financial advice, people. Do your own research would be sensible.
Absolutely. So yes, definitely go and speak to a mortgage broker before you do anything. I would definitely be my first piece of advice, and don't take advice for people like me who aren't qualified. So you're right. I mean, there's been some really weird things that have happened in the market, and that's one of them's been the downside of low interest rates. So we have got people who are experiencing a rate rise for the very first time ever since they bought their house. And that's come on the back of the financial impact of COVID, when lots of people either deferred payments or had support in place or had to burn through savings. And you've got other people who came out of COVID really well with more savings than they were expecting and had actually had lower spend during that period. And lots of people saw house price growth during that period as well, and have actually come down LTV brackets and have actually finding that they're remortgaging onto a lower rate because their property price has gone up so much, and that actually they've dropped down an LTV band. So yeah, it's just the most bizarre mix. I think as well, Ben's point is absolutely right, that anybody who's taken a 2-year fixed in the last couple of years has been actually had their affordability calculated on a really high interest rate, the expectation being that at the end of that 2 years you would go to the lender's SVR, and we know at the moment lenders' SVR rates are kind of up in 7, 8, 9s, and that's the rate that the mortgage has been stressed at. So people have headroom, even though it doesn't really feel like it right now. But people's expectations of, discretionary spend and how much we spend on other things in our life, maybe, I think we just need a bit of a correction in there. And the proportion of income that people are spending at the moment on housing, not just their mortgage, but their household bills and all of that kind of stuff, that stuff will start coming down now that inflation's dropping. It takes time to wash through, but people need to know that it will come. So get the help that you need now to get you through this pinch point, to get through the squeeze. If you don't have that wiggle room, and I know it hurts people who are on lower incomes or higher LTVs, or people who maybe don't have as much of a cushion, like they feel it harder, go and get the help that you need, whether that's speaking to a mortgage intermediary, speak to your lender. They've got tools that they can help you with in the meantime, or go and look at some of the financial management tools that are out there, like Sprive and Snoop, and places that can go and help you to manage your bills or get payments down, or find other ways just to take that pressure off while we get through this next little phase of normality.
Jinesh, have you seen any difference in your users, or have you seen any more people taking a bit more active control in this period of time, given all of the news around this, all of the uncertainty? I imagine any element of control people are really happy to have.
Yeah, we've definitely seen just a more engaged audience around their mortgage. I think in the past, I think people accepted low rates, and when things are relatively kind of business as usual, they don't tend to focus much on their mortgage. It's something they ticking in the background. They're kind of paying their monthly payments, and they're quite happy, and they're spending their money elsewhere and focusing their energy on other things. And now what's become really apparent is everyone's trying to really focus on their mortgage and what can they do and what's within their control to be able to kind of move that needle a little bit. And so it's really interesting when we kind of segment our user base, depending on where you are, depends on how you react. And so we're seeing some people spend a lot less money on and really try to cut back. And I think, Maria, you mentioned apps like Snoop and Emma and apps that can really help you kind of manage your spending. I think those are just really great tools to just kind of make sure you're spending on the key things that matter. And on the flip side, we are seeing people using apps like us who are increasing their overpayments, which I thought was quite surprising. But then on the flip side, we're seeing some user base that are just not even putting any extra money towards their mortgage, and they're really interested in the whole shop with Sprive feature because they feel like that's the only way they can go about essentially paying off their mortgage. And then on the remortgaging side, which is we're seeing every month hundreds of customers who are looking to essentially remortgage because their deals looking to kind of come up for renewal in 6 months. Talking to customers, product transfer seems to be very common. I think lenders are competitively pricing deals to kind of retain their existing user base. And so we're seeing a lot of customers kind of switching, especially with deals, the market changing quite rapidly and deals being pulled. They feel a little bit more comfortable because product transfers and switching with your existing lender is a little bit quicker than maybe refinancing from one lender to another. And also it's a little bit easier to do so. And so we're seeing a big portion of our user base switch from the same lender they're at and then kind of move to another lender. But on the flip side, they're also really keen to speak to a mortgage advisor because they want to make sure they make the right decision. And they're also very concerned about the fact that their monthly payments are going to increase, and that's going to have a significant impact on their kind of their personal finances. And I know like the government's done a few initiatives to kind of the people that are really feeling the squeeze, they could potentially go into like an interest only mortgage for a temporary period of time, and that may not impact their kind of their credit rating. Or if you need to, I'll kind of say again a last resort, but potentially extending the term out, which means that your monthly payments don't increase as much in the short term. So definitely the main thing I would say is homeowners are definitely focused on their mortgage, which is good for a platform like ours because we can kind of help.
Yeah, I mean, it's an interesting point that, and Ben, you sort of touched on this a second ago, because I mean, arguably these changes are being made in the market in order to curb spending to a certain degree and have an impact. But the government are trying to obviously shelter people from maybe the more disadvantaged areas of that impact being so absolute that actually it causes financial distress across a demographic of the UK population. So it really is a bizarrely odd balancing act that is happening between the UK banks, the UK government, and the Bank of England in order to sort of thread the eye of this needle to get the whole of the economy to where it really needs to be. And I mean that balancing act is, as you sort of touched on a little bit earlier on, Maria, with the graph on the Bank of England. It's Ben, we're seeing the Bank of England put salt in sort of slowly, but now they're putting bags of salt in to try and change the taste of the market.
Yeah, I think, again, just thinking about how that pain is going to be administered, the government's navigating a narrow path of not throwing money at this problem, which we cannot do. We've seen enough in the last 15 years post the global financial crisis. We can't see any more of it. For a whole variety of reasons, we shouldn't do it. If nothing else, it'll stoke the problem and make it worse. I think what they've been very good at, and in particular, really the industry has led this with the government. It started during the COVID period where lenders went the extra mile to help borrowers who are in difficulties when everything was shut in COVID. And we were going through a very difficult furlough position, which I almost can't bring myself to talk about because it's just a bad dream, isn't it? But I think in the same vein now, we've got the mortgage charters that the lenders have pulled together with various other parties, including the government. And there's options available for people who are struggling. So again, people should talk to a mortgage advisor about that if it's a case of what are my options and my deal's coming to an end. But if they're in genuine, real difficulties, then probably ultimately talk to the lender and just say, look, I can't pay, what can I do? And that's called the mortgage charter, and it's been helpfully pulled together without having to spend money. So the eye of the needle point and walking that narrow path is really right. But I do think they got the balance right at the moment. They should not throw money at the problem.
Yeah, I agree. All right, on that note, we're going to take a quick break. We'll be back with you very shortly.
We all know SMEs are the backbone of any economy, so why are they still so underserved? 67% of them globally say fighting for survival is their top challenge. It's time for financial services to put its cape on. At 11FS Ventures, we're building, researching, strategizing, designing, and engineering game-changing propositions with banks and fintechs to better serve the SME market. We've already helped RBS better serve small business owners and sole traders by bringing metal to life. So, the question is, what do you want us to help make a reality for you? Let us know at 11fs.com/ventures. That's 11fs.com/ventures.
Okay, so having looked at how we got to the current crisis and what the potential solutions out there actually are to get us to back to whatever normality looks like, and what we should really do is look at what we reckon the next 6 to 12 months are going to look like. I'm not going to ask you guys for a prediction of what you reckon the base rate's going to be. I think we go 2 digits, won't we, on that one? But maybe if we talk about really what we think the industry will look like in that period of time, because I mean we've talked about different solutions, we've talked about how the government, how different parties are sort of reacting, but Maria, what do you hope will happen in the next 6 to 12 months?
So calm would be nice. Just some stability and some predictability would be lovely. But I think even with that, I think everybody's predicting that we will probably narrowly avoid a recession. But the flip side between a 0.2 growth and a 0.2 decline is actually it's kind of a rounding error, and it's very, very fine margins. But the mortgage market and actually housing demand doesn't seem to act rationally in that scenario either, which is why it's so hard to make predictions and why I'm really pleased I'm not an economist. So I think the stats that I've seen this week are that, buyer demand is up 3% versus this time in 2019. So pre our Black Swan trilogy in what you would have called a more normal market. But we've also got we know we've had a long-term issue with lack of supply, but also the market's been really weird on supply for the last 12 months with new builds slowing down, no housing targets, which I don't think any of us expected to happen either. We're not really sure what's happening with buy to let. There's stories that, investors are selling up, and there's stories that that's not happening at all, and that's impacting rents and things. So the market dynamic doesn't act rationally. I think we just need to remember that while all of that's happening and whatever's happening to the economy, people still need to move because life is still happening. People are getting pregnant, people are getting divorced, people need to upsize, they need to downsize, they need to move for work or for whatever their reasons are, and that people still need mortgages for that to happen. So I think over the next 12 months, I would like, just to see things calm down a bit, but for us just to remember that at the end of this, there's like a human who has a reason to have to do the things that they need to do, and that we continue to help them and make those things happen.
Yeah, I think that's that stability, that calm, I think is a definite need, isn't there? I mean, Ben, many of the listeners that we've got would be concerned about, their home ownership status or their children as well, who are sort of embarking into this this market at a very different period than maybe that they did as well. I mean, do you think there's enough support in place right now for people
to get onto the ladder for the first time?
Both staying on that ladder. I mean, it gets the ladder gets more precarious the bigger your mortgage and the higher up that ladder you get to a certain degree, doesn't it? But as you say, the getting on that ladder in the first place is a very big step, isn't it? With all of the other pieces that Maria was talking about in terms of that impact, the constraints around that.
Yeah, and I think so. First and foremost, I think Help to Buy was really helpful. In terms of, I guess, propping up the market through and post a difficult period. But ultimately, it's still stimulus into the market that we probably don't need, and it creates some unfairness in the system as well. What I want to do is see the market absorb, the changes going on around us to the point where, that's the first point I'll pick up on is, say, is house prices, for example, thinking more with the first-time buyer in mind. We need a period of flat to a bit of negative for a good period of time to enable affordability for first-time buyers to come back. So even though prices are flattening off at the moment and we are seeing some first-time buyer activity, there's still loads of people who'll be holding off now because they're scared by the higher rates. But of course, the dynamic and the cost between renting and buying means that lots of people will want to buy, and that's what you're seeing in the demand that Maria's talking about. The key thing for me is just seeing that adjustment downwards in house prices, and in particular, one bit that's often missed is the relativity to inflation. So if you've got a 5% drop in house prices and inflation's at 10%, you can see that's a much bigger fall than is being covered. And then in the background, you've got wages keeping up to a point almost with inflation. You can see how affordability comes back over a period of months and certainly looking out beyond a 12-month period. So first-time buyers will come back. But I think the point at which they come back is when, if I'm a first-time buyer, firstly, I don't want to be in renting because it's expensive or I can't find somewhere. And then secondly, the key thing is I can look at rates and think they've probably peaked or they're even coming down, but it's certainly peaked. So I've got certainty there. I will buy. The other little bits I just talk around very briefly there's a lot of commentary around Armageddon, nightmare scenario and everything else. But in terms of housing transactions, we're at an incredible low at the moment. And we have actually been lower than long-term average for a long time. So that's typically about 1.4, 1.5 million transactions a year from a housing perspective. Roughly now we're definitely sub a million in terms of rub rate. So there's not much further it can go for all the reasons Maria highlighted. So we're at that low base already. So the recovery should follow, and it's as and when confidence comes back. And as I say, that's almost certainly when mortgages and rates have reached the peak of their cycle. So I'm optimistic, but we just need to go through this period of change and pain, and then we'll come out the other side inevitably. And I don't think, again, there's any more money that people should throw at propping up the housing market. The lenders should find a way through this and come out the other side with normal criteria, and we go again for a market recovery.
Jinesh, what do you think? What's the next 12 months going to hold? What do you hope for the market?
Yeah, I think more innovative solutions coming to market, I think would be nice. I'm seeing for first-time buyers, things like you've got Generation Home, that quite an innovative solution where parents can essentially help their children kind of get onto the property ladder. Seeing new lenders come on board as on ladder, that's basically again trying to help people kind of get onto the property ladder. I've seen other innovative solutions where rent your way to ownership type solutions and pathway points, and who are kind of building something quite interesting. So I think with kind of these kind of challenges, I think people looking around, looking at tech, looking at maybe what they could do to kind of solve some of the bigger problems we have around the housing market, because we obviously know we live on an island. There's only X amount of space where you can kind of essentially build new builds, and obviously there's a whole generation coming through who have seen their parents and grandparents buy their own homes, and they want to do the same. And I think obviously no one wants to really be renting for their whole lives and essentially paying off someone else's mortgage. So I think that is definitely interesting. I'm just seeing all the time new interesting solutions coming to play. Also, I think this whole situation, I think it's probably got a lot of the kind of existing community thinking about how they could probably potentially do things better. So obviously with like mortgage rates being pulled quite dramatically, it created a lot of issues across the board, whether it's customers, intermediaries, or lenders, and I'm having really interesting conversations across the spectrum on how we can use technology to kind of improve the customer experience. So at the moment, if you've ever got a mortgage, you probably are aware that it can be a time-consuming process. Providing a lot of information around your spending, your credit commitments, your property, and there's a lot of paperwork that you need to provide. And you see that in the insurance space, for example, you can get a buying quote journey where literally they know a lot about you, and very quickly you can kind of move from one policy to another. That doesn't happen necessarily as much as maybe consumers would like in the mortgages space. And so we are seeing kind of lenders talking about how they can do better integrations, etc., and use technology to kind of improve the customer experience. So I think out of and it's not all doom and gloom. I think through hard times you do get innovation.
Yeah, absolutely. I mean, it's a funny one, isn't it? I mean, the more we talk about this, the more both the problem and the circumstances and all of the variables that are causing it are probably as complex as the solutions that'll solve it, aren't they? Which is always the way. But maybe as just a quick fire round before we close out. I mean, in any of these periods, as you say, Jinesh, there's points of innovation, there's points of opportunity, but there's also areas of learning, particularly for the industry. What do you hope that the industry learns through this current odd period that we're in?
I mean, I would say that it's so important that we work together, and that there's good communication between both lenders, the intermediary community, and consumers. And I think sometimes there's been a bit of panic with customers. Really, like there was periods where interest rates were rising so rapidly, mortgage deals being pulled. All they hear is the press, and the press can be quite negative, and people making kind of knee-jerk reactions around their personal finances, and maybe that wasn't the right action that they should kind of they should really take. And so I think the more quickly communication can be passed on onto the end consumer, and they can get kind of high quality advice, I think is really important. I think generally people, when it comes to their mortgages, they talk to like a mortgage advisor, if they do that at all, every 2, 3, 5 years, and that's not very regular when you think about the mortgage and the cost of debt that essentially someone's taking on over such a long period of time. A lot of people end up paying hundreds of thousands of pounds in interest over the lifetime of the mortgage. And so I think just better communication, both with the existing lenders, if you have a mortgage, or through your mortgage advisor, on being with you every step of the way, and not just when you're looking to change that deal.
I'd say the same to you, Maria. I mean, and that's a really good point from Jinesh. Bizarrely, how big and important the relationship we have with our mortgage provider, but how little a relationship we generally have with them. It's quite bizarre, isn't it? But what do you hope the industry learns in this period?
Yeah, I mean, the industry continues to surprise itself, I think, with how incredibly resilient we are, and how we always manage to find a way through whatever it is we get thrown at. I think the thing that I've really stood out for me this year, though, is just how closely now we're understanding the link between financial health and mental health, and there's been such a focus this year on having the right support for customers, and really understanding like how they're feeling, and kind of giving them emotional support. But also for the industry, I've never seen so much chat on my network around broker health, around respect between brokers and lenders, around making sure that conveyancers and valuers are kind of looked after, while we've had real peaks and troughs of activity that have had negative impacts across the board. So yeah, for me, it's that link between financial and mental health. They're just like two sides of the same coin.
Yeah, completely. Ben, last word for you. What do you hope the industry learns?
Mine's very simple, and agreeing with all the points made. I think the only thing I would say is innovation in our market is welcome for all the reasons Jinesh rightly says, but it's also reflective of a dysfunctional market. What do I mean by that? If I go back 2-3 decades, lenders lent at 95 and 100% freely, because they underwrote the individual properly. And if we look back at those that took 100% mortgages, for example, over a 20-25 year period, there's almost a 0% default rate. Why can't they do it today? If I'm renting and I'm 30 years old and I want to buy a home, why can't I buy a home? So what I want to see, in particular now we've seen a lot of the risk in the next few months come off house prices, is lenders come back in hard at that sort of 95, possibly 95% plus area. And that would bring tenants in to become homeowners, which from a mental health perspective as well as a well-being perspective is also really key. So I'd like to see that. The final bit for me is there's an election at the end of next year, and that could be interesting because you never win an election in a bad housing market.
Very true. There's got to be some promises of hope and glory on the other side, isn't there, of that? So we will see what happens. We'll have you back foreshadowing not just the mortgage rates, but the potentially election results as well. But we'll see what happens on that one. Well, thank you so much for everybody. That does wrap up today's discussion. A fantastic conversation, albeit slightly scary one. But we'll definitely have to have you guys back as this develops and as the changes in the market continue to change. But for all of you, I mean, where can people learn a little bit more about you and your company? So Ben, maybe starting with you.
Yeah, so on our Mortgage Advice Bureau website, there's an awful lot of information and tools and help that can be provided. And my advice to anyone is do seek mortgage advice, even if it's not from Mortgage Advice Bureau, because there's so much that people can help with now.
Very good. Jinesh?
Sure. So Sprive.com, if you're interested in learning more about Sprive. If you're a homeowner and you want to save some money on your mortgage, literally takes a minute to download the app. We're both on Android and iOS. If you're interested in kind of following my journey, you can connect with me on LinkedIn.
Very good. Maria?
Yep, hit me up on LinkedIn, Maria Harris, Digital Cat.
Very good. You can always find me lurking on LinkedIn somewhere as well. Thank you so much for listening, everybody. If you did like what you heard, then follow our podcast. Don't forget to leave us a review. It helps us make it better and helps other people find the show as well. As always, if you want to join the conversation, find us on every social media point at this stage. Just search for 11FS or Fintech Insider, or email us on podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.